Somewhere in your core banking contract, there's language, or there should be, that determines what you can do with your own data. Hi, everyone. Welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. I think that language is about to become one of the most strategically important things your board has ever approved. And in a lot of institutions, it is not in the master agreement at all. It's in an addendum, it's in an API schedule, maybe a data services rider, something that you signed years after the original contract when somebody needed a very specific integration. Wherever it lives, it didn't get much attention when it was signed. The negotiation was about conversion credits, timelines, and price. The data language was boilerplate, and the deal moved forward. This is the third of my 5 predictions in this series on big changes coming to the core banking market. Over the next decade, the most important terms in a core contract won't be the ones that determine what you pay. They'll be the ones that determine what you're allowed to build. What's at stake here? Your ability to access, use, and build on your own data. Some of what I'm about to describe will look like a pricing problem, but it isn't. It's a permission problem that arrives in the shape of an invoice. For years, core negotiations have centered on price. Why? Because price is visible. Boards approve price, finance measures it. Price hasn't stopped mattering. It's just no longer the most strategic question. The strategic question is what your institution is allowed to become over the next 10 years. There's a quick way to find out where you stand. Ask 3 questions of your core banking contract. Can we reach our data when we need it? Can we use it in the applications that we choose? And can we build on it without asking permission every single time? If the answer to any is no, or even it depends, then somewhere along the way, your institution traded away options that your board never discussed. That discussion needs to take place now. In this core banking series, I've argued that the economics of the core are changing and that Advantage is moving above the core itself to an intelligence layer. But neither one of those helps you if your contract quietly limits what you can do with the data that your own customers generate every day. The problem usually shows up in one of 2 ways. Sometimes there's no fee at all, just language requiring vendor approval before another application connects, or simply nothing granting you real-time access in the first place. That version is really easy to miss because nothing shows up on an invoice. You discover it the day you try to build something. And that day is happening now. Sometimes it's the opposite, a reasonable-looking fee, a charge every time another system reads your data, maybe a usage fee tied to API calls. In a negotiation, the priced ones are easy to wave through because the numbers are small. But notice something I'll come back to. Both versions can end in the very same place. Your institution doesn't build the thing it's set out to build. One does it because it's too onerous from a contract standpoint. The other does it because it just ends up being cost prohibitive. Now imagine the next few years. You start with fraud detection, then a deposit attrition model, then a pricing engine, eventually commercial lending, all benefiting from these immense advancements that we've seen in artificial intelligence. That's how these capabilities get adopted, one use case at a time, and every one depends on reading institutional data. When your vendor prices access one request at a time, and many do, the math turns on you. Your strategy assumes you'll keep adding capabilities, so the more successful the strategy becomes, the more often you're reading your own data. Your consumption grows with your own ambition. And we have to be fair about this. The issue is not that access costs money. Streaming data, maintaining APIs, supporting infrastructure, those are legitimate costs. I would never argue otherwise. Some of you are already thinking of the obvious answer. Just govern your usage. Cap how much you consume. And you should. Managing consumption is a real discipline. We'll spend a whole episode on that topic. But it has a limit. You can control how much you consume. You cannot control the price per unit when the vendor sets it and the contract caps nothing. Govern your usage all you like. If the rate is uncapped, your worst case is still a number you cannot name. And that's the number a board actually needs. Boards don't approve technology strategies. They approve budgets. And you cannot responsibly approve a budget when a cost that could become one of your largest depends on how successful the strategy turns out to be. Now, a good board doesn't just reject that. It tries to manage it, put a not to exceed on it, maybe approve it in phases, maybe set a contingency. And every one of those tools needs the same thing. It needs a ceiling. It needs a worst case that you can name. And an uncapped per call rate on consumption that grows with your ambition doesn't give you one. In this case, the vendor holds the meter, not you. So then what happens in the boardroom? The strategy doesn't get rejected, it gets deferred. Somebody asks for a firmer number that nobody can produce. Somebody suggests a smaller pilot, and the pilot gets scoped down until the consumption question doesn't have to be answered. A fee you cannot forecast is not a cost problem, it's a permission problem enforced by your own budget process. And this is where I think most of the industry has it wrong. Everyone treats data access as just another cost line, something to benchmark and sharpen at renewal, like everything else in the fee schedule. It isn't just a cost line, it's a permission mechanism, the single most consequential control over what your institution is allowed to become, filed under legal boilerplate language and reviewed by people who were never told it was strategy. A clause that requires vendor approval withholds permission directly. A price nobody can forecast withholds it indirectly, and it does the job just as well. I've watched institutions decide that an AI initiative failed when the technology was never the problem. Sometimes, yes, the model underperforms, but sometimes the economics of access quietly made the business case impossible to approve. The technology gets blamed, but the contract was the constraint, and that's the trap. And I'm not claiming anyone designed it to work this way. This is how it functions, whatever the intent. Access is never denied. It's just priced in a way that makes denial unnecessary. So this is what it comes down to. The most consequential technology decision your institution makes this decade may already be sitting in the document nobody has read since the day it was signed. Not because it says no, because it makes yes too expensive to approve. And that's not a technology problem, that's a governance problem. And it belongs on a board agenda, not in a procurement file. So I challenge you to do one thing this week. Pull the contract, then pull the addenda, because that's where this usually lives. The API schedule, the data services agreement, anything signed after the original deal. Find the language governing data access, data usage, third-party connectivity, and then read it like a strategy document, because that's really what it is now. Some of you will find a meter. Some of you will find something quieter, which is no clear right to access your data in real time at all. Either way, you'll come away with the question that I hear constantly once people look at the contract. What should we have asked for instead? That's next week. I'll tell you exactly what I would negotiate and the one demand I would never make, because getting that wrong costs you the terms that actually matter. That's next week. I'm Virginia Heyburn, and that's your next move.